Euro to US dollar is sitting on the most dangerous level of the week. Over 2 billion euros in options expire at 1.1400 today. One wrong ECB word and we get a 100 pip freefall, or a brutal short squeeze. There is one number that, right now, is holding the entire euro-dollar complex together, and if it breaks, it won't just be a dip, it will be a capitulation. That number is 1.1400. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 2 scalp plays and 1 swing trade you can execute today, plus the one headline that flips everything. This is your Euro to US dollar emergency brief. Write this number down. 1.1400. That is the floor. That is the level where the market has parked over 2 billion euros in option expiries for today's New York cut. That's not a retail number. That is an institutional magnetic field. Price keeps orbiting it, unable to move far, and that is the trap. Because sitting just below it, there is a pool of stop losses the herd has placed at 1.1385. That is the gasoline. Right now, Euro to US dollar is printing 1.1402, down 10 pips on the session, and every time frame from the monthly down to the 1 hour is screaming strong sell. But here's the twist. The ADX is only 19.6. The trend is not accelerating yet. It is loading. And when you combine a coiled low ADX environment with a 2 billion euro option wall and an ECB decision 24 hours away, you get a volatility spring that will snap violently. The bias today is to fade rallies into the resistance cluster, but the real move comes after the rate decision. If we get a daily close below 1.1400, the euro enters freefall territory with a straight path to 1.1340 and then 1.1300. The invalidation level that resets everything is 1.1480. A strong 4-hour closeback above 1.1480 would negate the entire bearish structure and open a snapback to 1.1535. So 1.1400 is the trap floor, 1.1480 is the ceiling. Those are the bookends of risk. The herd is positioned net long, adding to the squeeze potential, while smart money sits below 1.1390 waiting to harvest those stops. Just this morning, a major prime brokerage flow report showed a build-up of sell stops at 1.1385, and I'm seeing exactly the same cluster on the COT-adjusted retail data. That's the story, a stop run waiting to happen, then the real direction. Now pull up your daily chart and I'll walk you through the technical deep dive that confirms why this is not a dip you blindly buy. Euro to US dollar is buried beneath every single moving average that matters. The 5-day moving average is at 1.1419, the 10-day at 1.1421, the 20-day at 1.1439. All three are sloping lower and acting as dynamic resistance. Higher up, the 50-day, 100-day, and 200-day moving averages are stacked in a perfect bearish alignment around 1.1550 to 1.1560. This is a death cross market structure. Price is trading deep in the red zone. The MACD on the daily is negative at minus 0.003, still expanding, no sign of a bullish crossover. The RSI is at 42, it's not oversold, which tells you there is still plenty of room to fall before any mean reversion bounce becomes structural. On the weekly, the picture is even more brutal. We've lost over 200 pips from the recent high and we are now below the 200-week moving average for the first time in months. That's the kind of breakdown that gets institutional desks re-rating their quarterly forecasts. Zoom into the 4-hour. Strong sell signal. Lower highs, lower lows. The 60-period moving average on the 4-hour is at 1.1445 and price has not closed above it in 6 sessions. The CCI on the hourly is sitting at minus 100, right at the border of oversold, which is why we could see a mechanical bounce to the pivot, but it's a trap bounce. Daily support levels. S1 is 1.1405, holding by a single pip right now. S2 is 1.1394, that is exactly the stop-hunt zone. S3 is 1.1376, a structural swing low from early June. Resistance. R1 is 1.1441, R2 is 1.1452, and a 3 is 1.1470. Notice how a 1 and the 50-period moving average on the hourly at 1.1445 form a tight resistance band. That is the roof for any intraday pop. Now here's what most traders miss. The 15-minute chart has compressed into a perfect symmetrical pennant. Lower highs from 1.1440, higher lows holding at 1.1400. This is a coiling pattern. It is the pre-breakout silence. The ADX on the 15-minute has dropped to 14, telling you energy is being stored. And right next to it, the options market is showing a gamma flip at 1.1425. If we cross above that, dealers flip from short to long hedging and it could exacerbate a squeeze. If we break below, they pile into the short. The hidden divergence trap. On the 4-hour chart, the MACD histogram has been ticking higher while price has made a marginal new low. That's a bullish divergence in a strong downtrend. It doesn't mean buy yet, it means be careful. It means that the first breakdown below 1.1400 might be a fakeout. That is the trap. That is where the liquidity grab setup comes from. And I will give you that exact play. But first, you need the crosser set context. The dollar index is glued to 104.80, supported by a fresh spike in Brent crude, up over 2% overnight on US-Iran tensions. Oil above $92 a barrel is a tax on the European economy and a tailwind for the dollar via safe haven flows. The US 10-year yield is holding 4.3%, not falling despite the soft CPI print last week. That tells you the bond market is pricing in sticky energy inflation, not a quick Fed pivot. The VIX is nudging above 17, and S&P 500 futures are red. This is a risk-off canvas, and the euro is the risk proxy. The correlation between euro to US dollar and the Nasdaq is running at 0.7. Equity weakness drags the euro lower. So when I look at the next 48 hours, my directional lean is bearish below 1.1480, targeting 1.1340 initially, and then the 1.12 handle that Goldman Sachs reiterated just yesterday in their 3-month forecast. They cited energy divergence and a hawkish ECB that can't save growth. That's the institutional narrative. The event that flips this view is a surprisingly dovish Christine Lagarde. If she downplays energy risks and signals a pause on tightening, the short squeeze could be aggressive. But that's the low probability path right now. I want you to be interactive with me right now. Do you think the dollar index breaks 105 this week? Comment yes or no. I'm tracking consensus. I'll read those responses and incorporate them into tomorrow's video. Your voice literally shapes the next day's focus. Most people skip this next section. That's exactly where the money is made. Keep watching. I'm going to give you the 3 trade setups. 2 scalps, 1 swing. Exact numbers. No guesswork. The first is the opening scalp. This is a high probability mean reversion play that works before the ECB volatility crushes the range. We are using the 5-minute chart. The setup. Price has to dip and touch the 1.1400 psychological support, and then immediately print a bullish engulfing candle on the 5-minute time frame. That means the candle after the touch must completely engulf the body of the previous red candle. That is the trigger. Entry is at 1.1405. The stop loss is at 1.1385, just below the stop cluster, below S2, and below the option expiry gravitational zone. That's a 20 pip risk. Take profit 1 is at 1.1435. That sits right on the pivot point and the upper band of the pre-news range. That gives you a 30 pip reward, a 1 minute, and 1.5 seconds risk reward. If momentum extends, you can take a second partial at 1.1445, which aligns with the hourly 50-period moving average, for a full 1:2 risk reward. What instantly voids this scalp? If the 5-minute candle that follows the bullish engulfing closes back below 1.1395, the stop hunt is on and you do not want to be long the opening SCLP entry, 1.1405, 5M bullish engulfing after tap of 1.1400, stop loss, 1.1385 take profit 1, 1.1435 take profit 2, 1.1445, optional. Risk reward, 1:1.5R to 1:2R invalidation. Void if 5M candle closes below 1.1395. The second setup is the liquidity grab. This is the counter-noise scalp for fast twitch traders. The 15-minute chart is where you watch this play unfold. The logic: that 2.1 billion euro expiry at 1.1400 plus the retail stops at 1.1385 will likely be targeted. We wait for a false breakout. Price spikes below 1.1400, it wicks down into that 1.13901.1385 area, and then within one or two 15-minute candles it snaps back above 1.1405. That's the trap closure. Entry is at 1.1410 on the snapback confirmation. Stop loss goes just below the wick low. If the wick hit 1.1388, place your stop at 1.1380. Target is the nearest intraday liquidity pool, which is 1.1435, identical to the first scalp's TP1, because that's where resting sell orders sit above the range. This is a quick 25 pip target with a 30 pip risk, so your execution must be razor sharp. Warning: if after the spike the price fails to reclaim 1.1400, and a 5-minute candle closes below it, the breakdown is genuine and you absolutely do not take the long. The liquidity grab fails, and you flip to the swing short. The liquidity grab entry, 1.1410, after false break below 1.1400 and recovery above 1.1405, stop loss, 1.1380, below wick low, take profit 1.1435 risk reward, approx 1:0.83R invalidation, void if 5M candle closes below 1.1400 after the spike. Right here I want to take an interaction pulse. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. It helps me tailor the next video's depth. Alright, now the big one. The third is the session swing. This is the trade that aligns with the 4-hour and daily bearish trend and captures the post-ECB directional explosion. The trigger is a confirmed breakdown. We need a 4-hour candle close below 1.1400. Not a wick, not a 5-minute probe, a full 4-hour body closure beneath that floor. That proves the stops have been run and the real selling has begun. Entry is on that close at 1.1395. Stop loss is placed at 1.1455. Why 1.1455? Because that sits above the daily R2 resistance, above the 50-period moving average, and above the high of the pre-ECB consolidation zone. It gives the trade structural room. That's a 60 pip risk. Take profit 1 is the June swing low at 1.1340, a 55 pip move. Once price reaches halfway to TP1, trail your stop to break even. That immediately removes risk and turns it into a free trade. Take profit 2 is the extended target at 1.1300, a full psychological round number and a level where we saw strong buying in May. That gives you a potential 95 pip gain for a 60 pip risk, a 1-minute and 1.6 seconds reward. Invalidation is clear. If price reverses and produces a 4-hour close back above 1.1480, the bearish structure is broken and we stand aside. That level is your pivot of pain. The session SWNG entry, 1.1395, for H close below 1.1400, stop loss, 1.1455 take profit 1, 1.1340 take profit 2, 1.1300 risk reward, 1:0.9R to TP1, up to 1:1.6R to TP2 after trailing stop invalidation. For H close above 1.1480, never risk more than 1 to 2% per trade. Scalps demand even tighter risk. No positions held through high-impact news like the ECB. You trade the reaction, not the anticipation. Stops are non-negotiable. This is how you survive to trade the next big move, so let's close the loop. The single most critical level for the next session is still 1.1400. If this level gives way on a daily close, the entire monthly trend accelerates to the downside, and I will have the updated blueprint with fresh gamma levels and the post-ECB correlation map 24 hours from now. Tomorrow, we focus on the ECB fallout and how it ripples into gold and Brent crude. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis, and then loop back to today's Nasdaq gamma flip later. Hit the like button, hold it until the haptic fires, and subscribe with the bell. Every signal helps the algorithm bring you the levels that matter before the move happens. Scalp the noise. Swing the trend. See you tomorrow for the verdict.